Sally exchanged an apartment building with an adjusted basis of $400,000 for an office building with a fair market value of $750,000. She also agreed to assume the mortgage on the office building in the amount of $200,000 and paid exchange expenses of $25,000. The other party agreed to assume Sally's mortgage on the apartment building in the amount of $125,000. What is Sally's adjusted basis in the new office building? So this question is specifically asking about basis. Now, there are many different basis rules in tax. There's a basis rule for purchases, basis rule for gifts, basis rules for transfers at death, even basis rules for divorce and separation. There's many more basis rules. Now, there's special basis rules for non-recognition transactions. One particular non-recognition transaction that may apply here based on the facts is Section 1031 like-kind exchanges. Section 1031 like-kind exchanges, the rules, specific rules apply when a taxpayer exchanges real property, here an apartment building, which is real property, for other real property, here Sally's exchanging for an office building, so real property for real property, and the property before and the property after has to be held for investment or business purposes. So here Sally has an apartment building that's held for business or investment purposes, exchanged for an office building held for business or investment purposes. So here Sally qualifies for Section 1031 like-kind exchange treatment, which is a non-recognition rule. We have to apply the special basis rule. So the special basis rule says that we look at the basis in the old property, which is the apartment building. We then add any money paid, which includes cash paid or any liabilities taken on, minus any money received. So any money, cash received, or liability relief, plus recognized gain minus recognized loss equals basis of the new property, which here is a basis of the new office building. Now in that formula, notice that we have to determine if there's any recognized gain or loss. So that's actually the first step, is determine, does Sally have to recognize any gain or loss? In order to determine that, we first have to calculate the realized gain or loss. Realized gain or loss is the amount realized minus the adjusted basis under Section 1001. Amount realized is what Sally's getting. Sally is getting an office building of a value of $750,000 and also liability relief of $125,000. So $750,000 plus $125,000, that's going to be an amount realized of $875,000. We subtract away from that the adjusted basis of the property given up, which is the apartment building, $400,000, plus the $200,000 of liability that Sally's taking on, and also the $25,000 of exchange expenses. So the adjusted basis in the property that Sally is giving up total is $625,000. So amount realized is $875 minus the adjusted basis of property given up, which is $625,000. That means that we have a realized gain of $250,000. If Section 1031 applies, no gain or loss is recognized. So that $250,000, no gain or loss to be recognized. However, there's a special rule, and that deals with if there's a Section 1031 like-kind exchange, and the taxpayer also receives boot. Boot is anything beyond the like-kind property, the real property for real property. So that includes cash, non-cash property. It's not, again, real property. That doesn't qualify for like-kind exchange treatment. Also, liability relief can be considered boot. There's a special rule, though. So here, Sally has liability relief of $125,000, but Sally takes on $200,000 of liability on other property. We're allowed to net the liabilities. By netting these liabilities, because Sally's taking on $200,000, which is greater than the $125,000 of liability that Sally has relieved, that means there's not going to be any boot. The way to think about this, Sally is taking on a debt of $200,000 on the new property. So that specific property has this $200,000 amount on it. Sally's going to have to pay that eventually. She's going to have to pay that off. So it's like she's paying $200,000 of cash. Yes, it's going to be over time in the future, but it's going to be in the over time. Payment of cash. The $125,000 of liability relief is like she's receiving $125,000 of cash from the other party and turning around paying off the liability. So the $125,000 of cash she's receiving, technically, right, constructive cash, right, can be netted the $200,000 of cash she's taking on. And because the net amount is that she is going to net owe $75,000, when you consider that, there's no boot here. So therefore, none of the $250,000 realized gain is recognized, so none of it will go on the tax return. But remember, we're focusing specifically on the basis and calculating the new office building she receives. So let's go through that calculation. So again, remember the formula is the basis in the old property, which is always our starting point. So we have our adjusted basis of property given, $400,000. That's for the basis in the apartment building, $400,000. That's always our starting point. And from there, we adjust, we increase for any money paid. So here, there's two amounts that Sally's paying. Sally is paying $200,000 through taking on a liability, also paying $25,000 of exchange expenses, minus any money received. Well, there's no actual cash, but there is constructive cash. Sally has liability relief of $125,000. So we subtract that amount away. We add any gain recognized, which here there's no gain recognized. We subtract away any loss recognized. No loss recognized. So we've gone through our calculation. And again, we adjust, or we go through, again, the starting point is the basis of the old property. We adjust for those items, and we get the basis of the new property, which is $500,000, the basis in the new office building. So the correct answer here is B, $500,000. That's the basis in the new office building.